Morning, everyone. This is Joe Scarice. Welcome to the Creative Bird Strategies House, here to provide education, networking, and opportunities. I'm also proud to say that we're here on Apple and Spotify. We're going to be getting set up here correctly. Something really happened. I'm sorry about that, guys. The actual site disappeared. So I'm going to just get things started here in just a few minutes. So I had to just get things started myself and recreate the site itself. So we'll get started here in just a few minutes. But again, we are live on Apple and Spotify. We are one of the only clubhouse clubs and houses that are now live video and live on Clubhouse simultaneously. We're here to provide a consistent theme of education, networking, and opportunity. So I'm really excited about this opportunity that we can go live both on Spotify, Apple, as well as on Clubhouse. I think it was a great idea that I have to give credit to Yardell Perkins of Perkatech, who's pretty much the Oz behind the drape behind all of what's going on here in our space for the Creative Bird Strategy. So go to creativebirdstrategies.com. And again, we have all our episodes so far. We just did our 5th episode. We've had hundreds of downloads. Really just excited about giving back to real estate professionals and really create a great following nationwide. And we're going to go over a lot of things going today. Today's discussion is debt service coverage ratio in real estate investing, the backbone of real estate right now in the investment space. If you do not know what DSCR is, you're going to get to know about it today. I'm also going to be putting a lot of the worksheets on live on our podcast today. I'll be sharing it and going over. But real quick, I'm going to do a quick invite to a bunch of peeps in the room in Clubhouse and just try to get some people in here. And we'll get started here in just a minute. And then we got obviously some great announcements as well as we progress through the room. Some great events coming up in March and April. So I'm just going to do a quick re-invite. Sorry, I had a little glitch in the system. The actual room disappeared. So I had to kind of recreate it real quick. And then also at the same time, recreate it on Clubhouse. So it just took a little extra few minutes. But I'm really excited about what we're going to provide from a worksheet perspective to everybody listening in this morning. So let's get started here. And get myself here. What is debt service coverage ratio? What is it? Like, where did it come about? How did it really get to really in front of us over the last 12 to 13 years? Wall Street saw this coming. They knew that they had to put their money to work outside of the market and decided to get into the lending business. How does it work? If you're in the market for commercial real estate financing, you might have come across the term debt service coverage ratio loan, or DSCR, and wonder what it means. DSCR stands for debt service coverage ratio, a type of loan that becomes increasingly popular amongst so many borrowers. Unlike traditional loans, DSCR don't rely on rely on personal financials. Instead, they base on the income of the property you're looking to buy or refinance. This means that even if you don't have a okay credit, meaning like a 660 or above, there's still options out there for you to qualify for DSCR loans. A debt service coverage ratio loan is a type of commercial real estate loan is based on the borrower's ability to service the debt using the revenue generated by the property's rental units. Debt service coverage ratio, DSCR, is a financial metric used to determine the ability to borrow to repay a loan by comparing the property's net operating income to the loan's debt service, principal and interest payments. Why are DSCR loans significant to real estate investors? DSCR loans are attractive to real estate investors because they provide a way to finance investments without putting a large amount of money down, the ultimate BRRRR strategy. The DSCR requirement ensures that property generates enough income to cover the loan payments, which reduces the risk for the lender and makes it more likely that the loan will be approved. Additionally, since the loan is based on the property's income, the investor's personal income and creditworthiness are less important factors in the loan approval process. DSCR loans allows investors to leverage the income from their properties to acquire additional properties or to make improvements to existing properties. This can help them grow their portfolio and increase their return on investment. Also, DSCR loans have less restrictive covenants. other than other types of loans, giving investors more flexibility to operate the property as they see fit and make decisions that will maximize their return on investment. A lot to think about here. DSCR is the backbone to real estate investing at this point. For entrepreneurs, this is the almighty golden grail of lending and investing right now. There's not an investor out there that is not aware of DSCR loans and what it provides and impacts on the growth and the strategy of real estate portfolio building. So please join us at thecreativebirdstrategies.com. Please join us at our podcast. We're going to dive into this today, and we're going to invite some people up. I'm also going to go over the worksheets live on the podcast in just a few minutes as we introduce some of our moderators. And if anybody would like to raise your hand and give some insight or input or questions, by all means, I'd love to have you join us. A couple benefits of DSCR loans, real quick, several key benefits. Higher to loan value ratios, flexible underwriting, faster loan process, and right now, the interests are lower comparatively to traditional lenders right now. We're coming in somewhere between 6.75 and 7.5% on a 30-year fixed, where most traditional lenders are offering 5-year ARMs, a shorter amortization, and the rates are now higher or near equivalent. We don't collect tax returns. We don't collect pay stubs. We don't collect W-2s. We don't collect 1099s. We look at the credit score of the borrower. We look at the cash reserves or available funds to put in or put into the deal or have available for the transaction. And we look at the income and expense of the property, which we'll go over debt service coverage ratio in detail on the podcast today. Let's see who we got in here. Maybe we'll invite a couple people up today. Make sure we get some people going here. I always like inviting some people up because, I like to put the pressure on a little bit. So I'm going to send some invites out to some people and see if anybody would like to join us. Give us just a few minutes. I think we should have a party up here. And listen, let's stick to the discussion of debt service coverage ratio today. I want us to focus on questions and statements toward real estate investing. So I just invited a couple other real estate professionals up. So hopefully we'll get a couple people up here and make a moderator there. Some debt service loan requirements: property income, debt service coverage ratio, property condition, borrower's experience, the credit worthiness, the reserves are all key factors when evaluating debt service coverage ratio. Now, I had a conversation with a client yesterday. She's looking to buy a 22 unit. Now, debt service coverage ratio still applies to that. We're not really concerned about a cap rate at that point because the loan amount's below $3 million. So we had a very deep discussion about the current income and expense of the property. And she's like, Joe, what do you think I should be buying this at? Well, multifamily debt service works a little different than single family through 4 family. When it goes above a 5 unit, most industry professionals are using a 1.35 debt service coverage ratio. In the single family through 4 family, it's typically a 1.2. Now, can you get a lower debt service coverage ratio program down to 0.75 or higher for single family through 4 family? Yes, but are the rates going to be reflective of based on what that loan looks like? Absolutely. Is there different options for prepayment on a loan in the commercial lending space at DSCR? Yes. Will that impact rate, whether you want a 5, 4, 3, 2, 1 on a downscale prepayment or a 3, 2, 1 or a no prepayment? Yes. And we go over that in detail to have a deeper discussion for you to better understand the direction of your debt service coverage ratio loan. We'll go with ladies first, of course. Good morning, Yolanda. Welcome. Brief overview, who you are, what you do, question or statement in regards to debt service coverage ratio in real estate.
Good morning, afternoon, evening, all, wherever you may be listening. I think I got enough bars to not have signal trouble. I'm Yolanda Smith-Charles, also known as Yolanda Sells Michigan. I am loving today in particular because my team is out there in the Bay Area to perhaps win an NFC championship. Who knows? But the topic at hand, DSCR, which is still a little bit new to me, well, a lot new to me. I do love though, and I do have people because I'm a licensed realtor who will ask me about, what do you know about DSCR? And I'm happy to say, Joe, you have shared some worksheets with me in the past that I've been able to utilize and do my own underwriting to kind of see how the numbers fall into place. So that's been wonderful. And I suggest anyone who wants those to reach out to Joe because I'm sure he'll share those. My question is, having listened before, that ratio, what if the property isn't currently a rental? Like, let's say it's not being used as a rental. Do you have to wait like a year of having the property as a rental before you can DSCR it? If you could speak to that. Thank you.
All right, so stay on mic.
Okay.
So which football team are you rooting for?
The Detroit Lions.
Are they bringing back Barry Sanders?
He's an honorary captain for today.
Oh, okay, good. He was a machine back in my heyday watching football. I had the pleasure of playing football with several very big guys back in the high school days. I don't miss football at all. I do appreciate it as a sport though. So we'll get into this real quick. So you own a property, you bought it, right? Do you live in it?
Yeah.
Okay. So is it empty? Is it vacant? Does it need repairs?
It is vacant and needs modest repairs.
Okay. So you bought it though. You own it, correct?
Correct.
Do you have any debt on the property?
No.
Okay. So it's free and clear. So let's talk third party. What credit score am I working with and for the client? Let's go separate. Let's separate you from the deal. So what's the credit score for the borrower?
Can I be aggressive here? Let's talk 640.
Okay, 640 is going to be a little tough to
Okay.
get because you're going to need to do repairs and bridge loans. So I want to make sure as a lender, I have an exit strategy for you. So we can do a renovation loan on the property. Okay. But I would probably be more inclined to say, listen, why don't you fix your credit and get it up to 660 to 680 before you jump into this parade? Because you're going to need that for your exit strategy. Remember, asset-based lenders, debt service coverage ratio lenders are not hard money lenders. It's somewhere in between. So we're not, I don't want to say we're not predatory because, I don't want to say hard money lenders are predatory, but they have to look at a little more predatory where they're going to lend a loan to own. So you really want to be at a credit score of 660 and above, preferably 680 and above to have that discussion. So why don't we just say you have a 680 credit score, right?
Yeah.
What's the renovation cost to the property?
6,000.
So let's round up 10,000. So
Okay.
I wouldn't suggest getting a bridge loan to renovate the property because it's so low. What I would suggest is maybe opening up an unsecured business line of credit in your LLC. As long as you have a 680 credit score or better, get the 10 grand off of a credit card in a commercial veil or under a personal business line of credit, renovate the property, stabilize it, right? So what do you think the after repair value would be to the property?
Let's say 100,000.
And it's a one unit?
Yes.
You're making this a very difficult loan, but we'll keep proceeding with it. So it sounds like it's
Well, some parts of the city, I can definitely get 100,000, but
okay. So let's just say it's 100,000 because I'm working it on the debt service coverage ratio of the property. Okay, so right now I'm doing 75% of 100,000, right? Which is what, 75,000, right? Okay.
Yes.
And I'm going to use a rate of 7.5%. Just a rate. Don't hold me to it. I'm just holding a rate to where, just a comfortable rate to be at. Okay. What's the rent collection per month?
It's 1750.
Okay. And this is property in the LLC.
Yes.
Okay. So I'm going to take out vacancy of 5%, right? Automatically. All right. As a deduction. I'm going to also take 5% out for property management. What are the taxes for the year?
Let's say 1,200.
1,200. What's the insurance?
2,000 a year.
I'm also going to take out $250 a month for deferred maintenance per door on any type of debt service coverage ratio loan. Okay. And what do you think your debt service coverage ratio is when you rent this great property out and hold it long term in a 30-year fix? What do you think? It's it's very good. 2.46.
Ah, so it's over.
2.4. It's really good. You're making 2.5 times more money than the debt. Okay. I can walk through with you on this every single time from a debt service coverage ratio. Are we talking about Detroit?
We're talking about Wayne County, but yeah,
Detroit market area. I mean,
yeah.
listen, if you could buy properties like this, I think the values are a little higher though now, between we're more toward 125 and 150. These are winners. You want to collect as many of these properties in your portfolio as much as possible. But you really need to be a 680 credit score or better to really pull this off on a consistent manner. Is that fair to answer?
Oh yeah, that's doable.
Okay, so did that answer your question?
It does. Yeah.
Okay. So we can go over this over and over again on the debt service coverage ratio on a share screen anytime, which I'm doing it right now on the podcast. So I'm going to stop sharing that real quick. But also, you want to look at another thing. You want to look at cash on cash return. So I'm going to try to pull that up here real quick. There we go. Cash on cash return. I'm going to do a share real quick. Hang on 1 second. I am going to share the screen. Give me 1 minute. So it's the cash flow worksheet, and I know we'll go to Joe Martella next just to make sure he'll give his input. It's not always about debt service coverage ratio; it's the cash on cash return of the property. So you want to look at that ARV of 100,000. You want to look at the $75,000 that you're going to pull out. You're going to look at the rent. Then you're going to break down your expenses, and you really want to figure out what you're going to cash flow per month outside the debt service coverage ratio on that door. And is it cost benefit? Is it really enough for you to be comfortable with to have all your money out on that property? Is it a performing mortgage for you in your favor? And that's a worksheet that I provide to all my clients. Anybody listening in, I will send these out to you. You can email me. I'll send these worksheet sheets out. We can have a deep discussion on many properties. We'll go over as many times as you need to understand one, debt service coverage ratio, two, cash flow worksheet, and three, how to buy the property from the BRRRR perspective on a Mayo, maximum allowable offer, and what you should be placing your offers in. I hope that assists you, Yolanda, and thank you for your inquiry on this. So we're gonna go right back. We're gonna get right into it. Give me 1 second. Moving around. 15 markets to watch if you want to buy a rental home in 2024. Very strong debt service coverage ratio markets. Now, again, I'm just giving you some. These are based on certain factors: migration and growing real estate markets. Number one, Nashville. Number two, Phoenix. Number three, Dallas Fort Worth. Number four, Atlanta. Number five, Austin. Number six, San Diego. Number seven, Boston. Number eight, San Antonio. Number nine, Raleigh, Durham. Number 10, Seattle. Number 11, Houston. Number 12, Denver. Number 13, Charlotte. Number 14, Miami. Number 15, Northern New Jersey. Now, this is not just saying the city proper, it's also the surrounding suburbs that are growing. So you don't have to get into the urban settings. You could look at the suburbs of these opportunities to look for debt service, hot real estate investor markets to watch in 2024. Good morning, Joseph. Welcome. Brief overview, who you are, what you do, and thoughts to discussion this morning, DSCR in real estate investing.
Good morning, Joe. Hope all is well. Great topic, and it's simple for you to explain, but it's complex to understand, right? Especially for a simple-minded person like me. Even with my rentals, I have buy-and holds. I've done several of them, several burrs. I also invest in tax liens. Quick question for Yolanda's scenario that you went through. Right, you said a little bit of a stronger credit score, but if Yolanda wanted to, she could get someone else with a stronger credit score to co-sign that loan with her, right, as a JV?
Bingo, you hit it. Joe, I want to thank you for that. You always come with something outside the box. So let's look at the LLC formation. As long as Yolanda is under 20% ownership into that LLC at 19% or less, the primary borrower of that primary that can be the guarantee with a better credit, and we can refinance that property no problems. The minute she has over 20% ownership with that lower credit score, I have to look at her credit. So there's I don't want to call them creative ways, but there's just very standard ways that you have a deeper discussion with someone and how to get to that starting line and getting into an investment property. There's a lot of people out there that have a 700 credit score, have an LLC, and just don't have the capability to get into a deal. But if you could joint venture with somebody that has that credit score, that stallion, that Clydesdale in the industry, we're not looking at personal income documents. We're looking at the debt service of the property. We're looking at the LLC structure. We're looking at the credit score. We're looking at the cash reserves, and we look at is the property eligible based on debt service coverage ratio. And we look at a fixed long-term loan. There's obviously different prepayment options. We have a deeper discussion in that to make sure that the rate works for you short-term and long-term on the strategy. Anything else, Joe, you got?
No, that's it. I mean, you briefly touched on cash return, right? And you mentioned my name because that's really what I go based off of, right? And one thing that's great about the DSCR loans is I talk to you all the time and learn something new about the flexibility that you have as a direct private lender, right? That the traditional brick and mortar banks just don't have, right? Whether it's a property that needs rehab, that a traditional bank just won't finance, right? If you have a hole in the wall, the bank is going to look at that and say, hey, we're going to deny you financing, or a leaky roof, or they look at that as a liability, even though you tell them, hey, I have the money to fix it, right? Or if you don't have the rehab money, right, you have the ability to bring that to the table and it's cheaper than hard money that when it comes across. So, but cash on cash return is important to me. I could go into my parameters if you wanted to, but that's not really the genre of your topic.
Well, I mean, Joe, a lot of people I think there's a huge opportunity with some bank REO and foreclosures that are going to hit the market over the next 6 months, right? A lot of these are not going to appeal to the home buyer, the owner occupant. There's just not enough knowledge both on the lending landscape, the real estate agent landscape, and the owner occupant buyer that understands FHA 203K. So where are these opportunities are going to be for like slate lipstick on a property that doesn't qualify under conventional loans that will qualify under the bridge loan, the BRRRR loan in the asset-based lending space to take it to a DSCR loan? You're going to see more of those opportunities in the next 6 months than you're going to ever see before, because the properties are going to come to the market all are going to need a little renovation to increase the value of the property, which are going to justify an investor appetite more so than a homeowner appetite. It's going to be much harder for a homeowner to get the appraisal to work on a conventional loan with a property that needs work. So this is a massive opportunity for the investor to take advantage of a weak owner-occupant buyer's market going into the spring market. This is going to be a true buyer's market. The DSCR loan and the fixed-to-rent loan is going to be one of the strongest options for real estate agents to provide to their investor base, more so than their owner-occupied base going over the next 6 months. David, good morning and welcome. Brief overview, who you are, what you do, and thoughts to our discussion. DSCR and real estate investing. Dave DeVito. Dave DeVito going once? There you go.
Sorry, Joe, the app was a little frozen. Good morning, everybody. I'm Dave DeVito. I'm a licensed real estate solution specialist here in Fairfield County, Connecticut, just outside of New York City. I'm a licensed realtor with Real Broker, as well as the longtime wholesaler, investor, and private money affiliate with Joe. Great topic. A couple of thoughts that weren't mentioned, I guess, yet. I guess, Joe, you did, in the sense that everyone that's investor, whether you're an investor or whether you're a quote unquote investor-friendly realtor, which is a term that oftentimes scares the heck out of me. And I say that because so many realtors, and I am a realtor, as I mentioned, just like to throw that label on their business card or their marketing or on social media posts, but they are being very irresponsible because they have not really taken on the training to be qualified to represent themselves that way. I can't tell you how many clients of mine, sellers that come to me with a terrible property that just is no way a good deal, and they're underwater on it. And I'm like, well, who'd you work with to acquire this property? Like, well, we had this agent-friendly realtor that helped us buy this. And the second part of that story is, I'll share, Joe, the CE session we did last year up here in Connecticut, where we probably had 35 or 40, realtors in the room, right? In the beginning, I think we even asked, who works with investors? And, almost all those raised their hand. And then you also asked about DSCR, and then probably like a quarter of the people raised their hand. And so I tell that story as a kind of a follow-up my first statement that if you don't know DSCR or private lending metrics, you have no right to claim to be an investor-friendly realtor. That's one of the points I want to make on DSCR. The second thing that I'll mention on DSCR is that if you find a really credible and talented, lender, which we all have in Mr. Joe Scarice here on this call, who you trust and is very generous with his teachings and coaching of all of us, you've got your underwriter. Underwriting is the most important thing. And yes, you should always do your own underwriting, but especially for a new or any kind of investor, if you don't pass the DSCR qualifications for a loan you're trying to get, then don't do the deal. I mean, that's the ultimate protection right there. That's the other problem that I see in a lot of these really overeager, overzealous investors out there. So, well, it didn't really hit this, so I'm just going to buy cash, or I'm going to kind of go out. Like, well, at your own risk. And listen, we're all human. I'm not saying that the DSCR analysis of a good private lender isn't always right, but even if it's slightly off, because everyone's got a different POV with appraisers and whatnot, it's probably too skinny of a deal that you should probably appreciate. It's always wise to be conservative in your numbers. Don't try to have the perfect storm have to be the reality to make it worth an investment that you're going to kind of put your hard-earned money and risk into in that regard. So there's just a couple of my thoughts on the topic, Joe. Very important, and I agree with 100%. DSCR is the bedrock of underwriting for really going after investment properties.
So Dave, stay on mic, please. So I really appreciate the kind words as always. So to me, the most important question when a real estate agent or wholesaler presents me a deal, guess what my first question is on the property? What do you think, Dave?
The first question?
The first question I have is, what do I want to know about that property if I'm going to debt service coverage ratio of the loan long term, potentially as a burn? What do you think my most important question is?
It's a common show. It's like what's the purchase price you didn't get it at? What's the ARV and what are the repairs? And I guess fourth, if it's a rental, is what's the current rental rate? I mean, those are the four, but I'm intrigued. What's the one that you're having?
To me, the most important number to understand debt service coverage ratio from the bridge perspective, meaning the fixed to rent side, then to the long-term hold DSCR side, is always and will always be the after repair value. Everything backs into debt service coverage ratio, the repair costs, and what you should be buying that property at based on the after repair value. There is no other number to question, because if you can't hit that market value based on the upgrades and renovations that either the wholesaler or the real estate agent's telling you that back into what you're buying it at, it's a non-starter. And this is a problem as we see an influx of conversions of office retail into residential and more multifamily building. What will that do to values over the next 12 to 18 to 24 months to comp a property to come up with the market value? It's going to go down. So when you get an after repair value from someone, a wholesaler, what are you doing as a real estate investor friendly realtor to understand the comps in that market to derive your after repair value, Dave?
Well, you always have to look at, the well, likeness of property, make sure you're comparing apples to apples. You want to look at the, properties that have been sold ideally in the last 3 months or less. That's the other thing. I see a lot of people, wholesalers, I am a wholesaler, that send me comps from like a year and a half ago, just to kind of justify their number. And, like condition as well. That's the other thing. You got these guys that basically just don't understand what the rehab costs. But it's interesting you say the ARV is not the only thing, but the main thing you got to know, Joe, because in my opinion, and my point was, ARV doesn't tell you enough of the story. And what I mean by that is that a lot of realtors or even investors, when I try to, qualify them to learn their buying criteria, they're like, oh, I'm just looking for a high ARV. Yeah, it doesn't tell me anything because the ARV could be $10 million. Buying it for $9.9 million and it needs 500 grand worth of work. The ARV didn't tell you the full story. And that's why I kind of, in my response to you initially, was you need multiple variables, not just the one. So I'd be curious of your thoughts on that.
Well, I like to start with a certain number and I work my way back because I look at my after repair value. I then back off, I take off, I take the 70% rule of that after repair value and then back off my repair costs, then back into my cash flow, then my debt service coverage ratio. And does it make sense for me to deploy my money to buy the property, renovate it, stabilize? Does that make enough money for me to justify either leaving a little money into the deal or cash flowing with infinite return with no money into the deal on the refinance cash out? And does my debt service coverage ratio meet my expectations and ties in my vacancy, my deferred maintenance, my taxes, my insurance? And can I be comfortable with that property long term to hold in my portfolio? I look at the full picture. I take a Mayo worksheet and I evaluate my number there. I then take my cash flow worksheet, evaluate my number there, then get into my debt service coverage ratio worksheet and make sure my numbers work there. And then I also put a rehab construction template together to make sure my construction scope of work makes sense to generate that new value to the property, right? That new value to the property, and then backs into, does it match up with my market rent, or do I need to go Section 8 or affordable housing rent in that market? Who is going to be my tenant? How is that lease going to look like? How am I going to generate my income? How long is my property going to stay vacant until it's occupied with the right tenant? So I'm taking a lot of moving parts into account. Am I having a management company in effect in place, or am I self-managing? There's a lot of moving parts in my final decision makings.
Yeah, no, I agree. One other question, Joe, that I failed to mention, which I think is important, is that can you explain to the group about, you see all these listings and they're kind of like, realtors or wholesalers are promoting undervalued rents as kind of like a positive, like a marketability.
Yeah.
That's a big problem because you're going through and trying to get lending. It's the as is rents, not
Correct.
the pie in the sky,
Correct.
Potential market rent kind of thing. So can you kind of like explain and reassert that to the group too? Because it's comical to me.
Yeah.
How many realtors and wholesalers, they're like beating their chest like, oh, look, these are all under market rents. This is great. Oh, they're leased up for the next, 9 months. Like, well, then how is that a good thing? You're stuck. So if you can talk to that a little bit, I think that's another important element. That's really a big misunderstanding with people.
I don't think I think it's a misunderstanding and a miseducation to the real estate agent promoting that concept, because from an investor perspective, I now have to look at that property not as a debt service coverage ratio loan, because I can't use future rents if there's a lease in place with a rent below the market, right? So now I have to look at that property, right? Now there's some moving parts to this, right? There's a tenant in there, right? How am I going to upgrade the property and create that new rental value and the new value to the property around the current tenant and justify? Okay, so
Exactly.
so a lot of my landlords that are buying properties like that, they're doing cash for keys, okay? Or they're taking a bridge loan out for 12 months, knowing they're going to get that tenant out, turn that property around, put the 25, 30, 40, 50 grand into the property, generate a better lease, a better debt service coverage ratio, and a better value so they can refinance the property 6 to 9 months from now in a bridge loan, paying only interest only. Now they are playing a risk to the market. I'm not going to tell you they're not, but it makes no sense buying a property and trying to debt service a property off of the current rent and saying, hey, I'm going to use a future rent. You can't use a future rent if the property is leased up right now for the next 6 months. So it's either cash or keys, get rid of them. Two, you got to buy it in a bridge loan and an interest only loan and estimate renovation costs, either working around that tenant or getting that tenant out over the next 6 to 9 months and then renovating it quickly, stabilizing it, and then refinancing it into a long-term 30-year fixed loan down the road, using that future rent as a present rent and that future value as a present value once that property is restabilized. Does that make sense?
Absolutely. That's a perfect scenario. Absolutely.
Excellent, Dave. Thank you as always. And Dave will be one of our team members on the Creative Birth Strategies podcast in the future. We're just finishing up some things, and hopefully we'll get him to interview some great talent up in the Connecticut market.
Looking forward to it.
Thanks, Dave.
Hey, Joe, if I may,
Sure.
right? These, exactly what Dave explained, and he went into like the realtors are investor friendly and what have you. And this is what gives an edge, at least in my opinion, to realtors, even wholesalers for that matter, that are, whether they're new or they want to be investor friendly or they really want to market a property correctly. If they're part of this room and they get in your spreadsheets, there's no reason why they don't have an educated way to approach an investor. I have had countless realtors who are investor friendly. They said, hey, look at this property. It's a great buy and hold. And then I look at it and I was like, it's going to cash flow $50 a month. Like, what happens if something breaks? My cash flow shot for 2 years, 3 years. They can use these worksheets and actually come to the investor correctly or price out their listing correctly or their off market or a wholesale deal correctly to an investor and actually present all the facts. Hey, this is what it's going to cash flow and everything. And that's what's great about this education that you provide.
Well, I appreciate that, Joe. And just to let you know, I'm going to be doing some presentations over the next several months in several areas in the Northeast. We have a big workshop coming up February. I think it's the third Saturday in February. February 17th, where I'm actually doing a 9 to 12 discussion, giving the worksheets away, literally giving them to everybody, breaking them all down. We're going to have lunch afterwards. We're going to have masterminding discussions. I'm going to get really into it for probably 4 or 5 hours with everybody. And there's no charge. I'm a licensed professional. I don't feel that it's a disservice by me charging something like that. I'd like to earn people's trust and their engagement and their being part of their power team by giving them the right information that they need. Okay. I'm a fan of workshops. I'm just not I just don't feel comfortable providing that as part of my service. Jim, good morning and welcome. Brief overview, who you are, what you do, and thoughts to debt service coverage ratio in real estate investing. And please give us an update to the Great Mile High Real Estate Investor Summit.
Good morning, Joe. Good morning, Clubhouse. As always, Joe brings the meat to the table. Hey, I'm Jim Edenfield. I'm in Broomfield, Colorado, just north of Denver. I own 2 meetup groups, Realty Investors Group, RIG, and also Invest Success, which is a 12-month coaching program. And we host the John Fisher's Breakfast Club and Invest Success Happy Hour. I'm a partner with Tim Emery down below there. And we host together. We host actually 4 different meetups in the Denver area in the course of a month, and we have a lot of fun out here working with new investors. We train them, teach them, and the thing I say probably, I don't know, many times a day is you gotta know your numbers. We teach that. DSCR is one of those big numbers, and I'm surprised as I go to these meetups and I talk to people that's been doing investing for a while, and maybe they're just doing fix and flip, or some of them have buy and holds. even the ones that have buy and hold properties, you go DSCR and this glaze goes over their eyes. It's like I just spoke Greek to them. And, they come into the meeting and go, I heard about this special loan. What the heck is it? How does it work? So I always say to new investors, I love the new investors, is get educated, find out what niche you want to go into. And then if it's a buy and hold and you're going to start stockpiling portfolios and refinancing, this is a term you need to know. And you need to, get with people like Joe that you have a question, he's going to work it all out for you and he's going to provide the funds for you. Some people says, oh, it's like science. I don't know. But for Joe, he could probably do it in his sleep with his eyes closed, hands behind his back. So learn the numbers, learn all the numbers, and really delve down. And like I say, if you're going to be getting into more buy and hold, you really need to nail this down. Hopefully, you're not going to stop at 5-10 properties. You're going to grow, and after a while, you're going to hey, I need to refinance all these. And Joe's your guy. Joe's your guy. The Great Mile High Real Estate Investor Summit. We're coming up in March. It seems like it's going to be here tomorrow. I've been talking about it so long, and I know a lot of people will be glad when it's over. They quit hearing me talk about it, but I'm going to be bragging about it after the fact. This is a multi-day event. The main sponsors is Joseph, Linda with Realty 411, Invest Success, and Rig, and we've got other sponsors locally and from across the country. We got speakers coming in. We got about 30 speakers, a very wide variety of topics. We're going to have lunch included every day. It's going to be happy hours, drink tickets for the VIP guests. Just going to be fun. Our keynote speaker on Saturday is going to be Mr. David Seymour, star of the A&E Flipping Boston. He's an awesome guy. We met him at Joe's event out in Philly last year. Got to sit down and talk with him. And in preparing this, getting ready for this, I've been communicating, talking with him. He's an awesome guy. And I'll just say one thing he does. What he does is he'll put up a QR code and say, click the QR code and you get 15 minutes one-on-one. And we've got a quiet room. You can go sit down and talk to him. So come join us. We do have a discount that is ending February 15th, 5% off. Buy now, 25 is the code. I've already put it in the chat. And we've got a great rate at the Curtis Hotel downtown. Beautiful hotel, Hilton Doubletree. We've got a great rate at $179. The last time I looked on the website, their rate for that weekend is starting at $212 up to about $300. So great deal. It's going to be a great time. Some of our friends here in this room right now are going to be here. So you too, come join us. Hear some great education and meet some of your clubhouse family in person. It's nothing like it. Walk in the room is like, hey, I know that voice. Hey, there's Mr. Joe. Back to you, Joe.
Thanks, Jim. I've been friends with David Seymour for 20 years. I worked with David when he was working through the Lindahl Group, the David Lindahl Group out of Boston. So Dave and I go back a long time. So I specifically reached out to him to speak at the Philadelphia summit last year, and it went really well. We had 175 plus people. We're going to have over 250 people this year at an iconic location, the Mummery Museum, and we're going to have a mastermind luncheon the day before, mastermind happy hour, as well as a dinner following that great event. But we have all new set of speakers in Philadelphia, which is following the Great Mile High Summit in April, which I'll post up in just a few minutes. But, Jim touched on a couple things. There is no property limit in the debt service coverage ratio arena. Okay? You can have as many investment properties as you can afford to facilitate, as long as you have the proper reserves, credit score, and the proper debt service on the subject properties. Okay, you can look at anything from 1 through 4, 5 through 25 in the debt service coverage ratio arena. Reserves are looked at strictly based on per asset basis. There's no income verification of you personally. So if you're a real estate agent, why are you on the sidelines giving money away and deals away to your clients? You should be grabbing these opportunities, taking them down yourself. You're the front line to the real estate industry. Some thoughts to add to that and things to think about. Good morning, Mr. Cyrus Dixon. Welcome. Brief overview, who you are, what you do, and thoughts to discussion this morning. DSCR in real estate investing.
Hey, listen, good morning, bro. I appreciate you, Joe. My name is Cyrus Dixon. I am a buy and hold. I flip with my in the partnership of my business with my wife. Sorry about the FOMO there, but we have a company called the Hobo Group. Hobo stands for helping others buy and own, and we're based out of Richmond, Virginia. Listen, I'm just a fly on the wall. I'm learning more about this DSCR as we're starting to pivot and transition our business. But I will say I have recently started a real estate wholesaling program that I partner with the Juvenile Justice Center here in Richmond, Virginia, to teach young people how to get involved in real estate and helping them transition into trades when they get out for a brighter future. So listen, sorry about the conversation, but I'm a fly on the wall this morning, Joe. I'm trying to learn as much as I can.
Cyrus, quick thoughts on the Richmond RVA market. Is that peaking out right now in debt service coverage ratio, or is there still some opportunities, or do you have to dive into the rural markets to identify good debt service coverage ratio? And is that getting a little more complicated?
I mean, honestly, I would say it hasn't peaked. I would say Richmond, in my opinion, is becoming more of a metro city, and so there's a lot of development that are being built in places that we just didn't see that are just not too far from downtown Richmond, right? So about a 45-minute hour radius of Richmond for those who haven't been here is a large area. So what I'm seeing is that there's still projects that are going on. I'm hearing of a lot more people that are getting into debt coverage serving DSCR loans, and so that's what has really sparked my interest as I'm trying to pivot my business and acquire some more properties.
Thank you, Cyrus. Great chatting with you this past week. We'll definitely have to get you on the podcast live and discuss and get down and dirty with the RVA market and your new program that you're offering to the youth of our future here in the real estate investing space. So what are some signals for 2024 for real estate investors? The financial world is buzzing with anticipation following the Federal Reserve's recent choice to keep interest rates steady. While markets analysis largely predicted this move, the unexpected twist came from the Fed chair, Jerome Powell, who hinted at a possible 3-rate drop in 2024. The surprising announcement has ignited curiosity and raised questions about its potential impact on real estate portfolios, particularly for investors seeking to navigate evolving landscape. You really need to kind of dig in to understand that Fed's decision. At year's end meeting, the Fed chose to halt interest rate hikes, keeping short-term rates within 5.25%, 5.5% range. Powell's assurance of scaling back on rate increases indicated a shift in monetary policy heading into 2024. Predictions suggest a more relaxed atmosphere for mortgage rates, offering potential relief for aspiring homeowners and investors with debt service coverage ratio portfolios. The positive outlook is supported by housing economists pointing towards a favorable period ahead. This is an absolute unbelievable opportunity for you to get yourself educated in DSCR. Rates right now are going somewhere between 6.75 and 7.25 with a direct lender. There's too many brokers in the space right now jamming people with higher rates and higher origination. So you need to identify who your direct lenders are and who is basically a glorified broker. Okay, you got to be very cautious because you got to remember a lot of the brokers are tied into lenders like ourselves and are just adding cost to the loan. Refinancing opportunities for debt service coverage ratio portfolios. The present is an opportune time to refinance and secure lower rates. You could even buy the rate down. Okay, you have that flexibility. The market desire for rate reductions could lead to unforeseen developments. While an immediate surge in real estate sales is not expected, a potential boom may unfold in the next 60 to 90 days. The affordable housing segment is poised for price increases due to limited inventory and high demand, presenting an opportunity for buyers to act quickly. So debt service coverage ratio, where there was some discrimination against affordable housing loans, we like debt service coverage ratio in the Section 8 space. It's nearly guaranteed money from the government, and you're getting almost 90% of your money up front from the government on a month-to-month basis, as long as you maintain that property correctly. I knew at one time there was banks that really didn't want to touch Section 8, and if it was Section 8 signed lease, they would turn it away. Now they welcome them because there's no other option in some of these urban cities. I feel all the urban cities throughout the country are going to be close to 30 to 40% affordable housing within the next 24 to 36 months. And market rent's going to decrease. And there's going to be a balance between the two. Evan, good morning and welcome. Brief overview, who you are, what you do, and thoughts to the discussion this morning. Debt service coverage ratio in real estate investing.
Working through one of the agents that we sold a property to. They had a couple self-inflicted wounds, did like permits, got involved with a contractor that couldn't do the work properly, so she ended up blowing the budget by about 50,000.
Mm-hmm.
And do you have anything that will work with someone on the exit? So I'm trying to talk her into turning this into a bird.
Okay.
So I don't know how strong her credit is.
So first, I would want to know what her credit is, right? I'd like to know what the after repair value is. I'd like to want to know what the market rent is. Is it leased or can it be leased? If it's for sale, it's got to come off the market and be leased. Because since I'm an asset-based lender, I need a signed lease to justify the income and expense and understand the debt service coverage ratio of that project and see how much leverage I can go up to. Now, most DSCR lenders can go up to 80% based on DSCR of 1.2 or better, or even 1.0 or better. I don't really want to go that low because now if you have a vacancy, now you're kind of lopsided. But we'll look at that. And again, it's a 30-year amortized loan. We could also look at, hey, listen, you don't want to hold it long term. You want to be out of it in 3, 4, 5 years, or 2 years. We could look at different prepayment options and we'll have a much more franker discussion. But I would need to have about a 5 to 10 minute discussion with her just to kind of get comfortable and see what options there are. Is it a property in the name of an LLC? Can it be transferred into the LLC at closing? Who are the members of that LLC? Is she the only borrower? I mean, there's more detailed questions I'd like to have. One, to make sure we position her in the right place, but two, I'm doing the right thing for the client. So I still have my banker hat on, even though I'm in a non-QM space. I do follow a very integrous code because I want that continuous business, not just from the referral, but from that client. She might tell 3 people that did a great job for her. Does that help you out, Evan?
Yeah, she would definitely have it leased out. And the other question I had for you, what kind of season period would you have?
I don't typically have a seasoning, but I'm comfortable with 3 months or 6 months. So 3 months is obviously exercises the max value of the property. 6 months give us a little more comfort, but I could look at either 3 months or 6 months seasoning options for the client as a DSCR lender. Now, traditional lending only looks at 6 months or better. They don't have much of a choice because that they follow more of a Fannie Freddie environment. Even if they're offering non-QM loans, they still follow Fannie and Freddie, so they're regulated. We're not as regulated on the seasoning period, and we could sell that paper off to our secondary market and our service provider rather quickly. No problem. Some exit strategies and market engagement. Pressure on flippers' margins underscores the importance of robust risk management. Investors may need to reconsider their exit strategies, just like what Evan was discussing here for a client, shifting from quick flips to potential long-term rentals. Financial institutions are exercising caution, influencing the pace of re-engagement with the market. Investors should monitor these shifts as they impact portfolio decisions. Bottom line, real estate investors must strike a balance between cautious optimism and prudent skepticism, considering the recent Fed decisions. While the landscape is evolving, taking informed steps such as monitoring interest rate trends and seizing refinancing opportunities is crucial for securing investments. Armed with knowledge, foresight, and a blend of caution and courage, investors can navigate the changing real estate landscape successfully. I always tell people to follow Mortgage News Daily, get that RSS feed, understand what the rates look like every single day, Monday through Friday. How are you staying proficient with the market if you don't know what the rates are? Does everybody in this room know what the rate closed at, the base rate for conventional financing on Friday? I do. It closed at 6.90. You need to stay familiar with your market if you're a real estate professional. Good morning, Justin, and welcome. Brief overview, who you are, what you do, and thoughts to discussion this morning, DSCR in real estate investing.
Good morning, Joe. Good morning, everybody. My name is Justin Jefferson. I'm currently in the southeastern Louisiana market. I'm a licensed broker, done several fix and flips, etc. And right now, I'm working as a project manager in addition to all of those other things for a company that builds quite a few homes every year. But anyways, as far as DSCR loans, first I'll say Joe has really, I did know of debt service loans prior to these rooms, but I only knew it as in the sense of it's something that exists. Just being here consistently, I've learned how to calculate. I've learned how to manage, and I really view DSCR when you get to that point in your career. I just, on my roadmap, it's kind of a pivotal point from a novice to that next level for me. That means I have several properties. They're performing, or I like to take it to the next level, whether that's using some of the equity in those deals to buy more properties, or that's just to fix up what I have. But 9 times out of 10, with the mindset that I have, it's debt service loans are going to be used to leverage myself to buy more properties and to get into more deals and to expand my portfolios further. So it's a very powerful tool, and it's a strategy that, if you're serious about building, wealth and a lifestyle based on real estate and even other assets, I think it goes without saying that it's something you're going to have to know about and be very familiar with, and then get your knowledge base to a level where you can use that strategy best for you. And always keep you a good expert in your corner who can help you decipher how to use that tool best. So those are my thoughts, Joe. Thank you.
Thanks, Justin. Debt service coverage ratio, DSCR loans, we're going to discuss these. We're going to go in deep in Denver and Philadelphia, and I'll do a workshop at both locations, providing insight, understanding asset-based lending, understanding DSCR loans. And I just posted the Realty 411 Investor event in April, following up the Denver event. Please register for both. Would love to see you at both of them. They're going to be totally two different sets of speakers, very educationally based, nothing being sold at the back of the room. We're one of the only groups out there on Clubhouse that's offering yearly varied events throughout the country. We're now on a podcast live on Apple and Spotify. We're extending opportunities to market your business on the podcast. So please reach out to me. I want to help you build your business through the Creative Bird Strategies house. That is what we're set up for. We have a great social media strategist, Mr. Yarrow Perkins of Perkatech. I call him the Oz behind the drape. And he's so helpful, and he's a blessed friend and a business associate. And I'd love to make sure that you guys have the opportunity of promoting your business wherever you are throughout the country. So DSCR loans are a type of commercial loan where lenders assess the borrower's ability to cover the debt payments based on the income generated by the property being financed. The biggest challenge in commercial DSCR loans can vary on market conditions, economic factors, and individual circumstances. But some common challenges include market conditions, property performance, interest rate risk, economic downturns, leverage levels, which I think is very important to understand, regulatory changes. There's always changes on leverage and debt service coverage ratio, credit score requirements, and credit risk. And also the property type and location, the covenant compliance, and successfully navigating these challenges require careful risk management through due diligence and ongoing monitoring of both market conditions, financial health of the borrowers. Lenders must adapt to changing circumstances and employ strategies to mitigate potential risk associated with commercial DSCR loans. Tim, good morning and welcome. Brief overview, who you are, what you do, and thoughts to a discussion this morning, DSCR in real estate investing.
Good morning, Joe. Good morning, Clubhouse. This is Tim Emery out in Denver, Colorado. Happy Sunday to everybody. Great topic as always, Joe, and lots of good insight. From my background is 20 years in real estate. Done everything from sell houses to buyers and sellers to property management to fix and flips, and now we coach and teach and mentor people how to fix and flip in a local area, and specifically Denver. Jim, who's up above, is my partner. The Great Mile High Real Estate Investor Summit coming up. Buy your tickets now. Come out, see us. It will be really valuable. But you know what I really focus on is your local area. And when we talk about DSCR or any type of rental properties or the BRRRR method, you got to know your local markets. You got to know what's going on, and it's not only just a general citywide. It's the suburbs as well. If you don't know what's going on in the suburbs, you don't know what's going on anywhere. You got to figure that out. And to find the right deals for DSCR is it's a little harder in places than others. Denver is not a great market for rentals right now currently if you're buying straight up, because our numbers are our average median house price is $628,000. So how do you make a $628,000 4-bedroom 3-bath house rent for enough to cover that mortgage? And that's really the hard part. So Denver's market is really looking at a appreciation play. So I know earlier Joe was talking about making $50 a month isn't worth it. In Denver, making $50 a month right now on your first year may be worth it, and being able to raise rates, raise your rents up on a leasing year to year lease, $100 a year starts to make sense. So that's what we're looking at in the appreciation. If that 628 is our median price, and I might be off a couple $1,000. Next year it's going to be 5, and the year after that it's going to be 700. And so we don't have a cash flow here. So that's something to really take into consideration. And having Joe as an expert to talk about that really puts it in perspective of where you can buy and where you can use these DSCR loans. So Joe, back to you. Maybe you want to kind of cover what happens when we do have those tight numbers and isn't it worth doing a DSCR loan?
Well, it all depends. It's how you buy. You make a great investor friend of mine. I've known him 25 years. You make money when you buy. It's not an old phrase. It's not a new phrase. It's just a standard. You make money when you buy. If you're not buying correctly, whether it's for flip or for hold, in any evolving market, you're going to find yourself in a lot of trouble on the back end. Okay. There's just not going to be enough meat on the bone for anybody to, afterthoughts. I get very concerned when an investor starts listening to people that are not investors and taking advice from people that are not investors, and they listen to all the wrong people, whether they're private lending out their own money, whether they're buying and renovating to hold, whether they're buying and renovating to flip. I've seen more over leveraged clients, potential clients, in the last 12 months because they just didn't listen. They still think the market's making a comeback. Okay. I think we're in for a tough 24. I think things are going to get a little tight. I think values are they're leveling off. across the country. If somebody's telling me that, if they think I'm wrong, please, by all means, please let me know. I don't think I'm incorrect. I think your debt service coverage ratio and your rent market right now is flatlined or decreasing in most markets throughout the country, other than Midwest, Southwest. But follow your migration rental reports. They all justify that everything's getting away from the East and West Coast. Everything's going down in the middle of the country. There's more favorable landlord-tenant laws. There's more out-of-state landlording than ever before. There's no restrictions in the debt service coverage ratio market with out-of-state landlords. We welcome out-of-state landlords. How many people that bought properties 15, 20 years ago couldn't find a credit union or bank to finance them because they didn't live in that state? That doesn't exist anymore. And those credit unions and banks don't even have an appetite to lend on debt service coverage ratio loans. They can't afford to do it. They're in too much of a financial hardship where they need deposits to keep their doors open than worrying about investment financing. When they were giving money away at 2 or 3% several years ago, if you're giving that much money away now, back then, and now rates are triple, are those banks making money off that 2 to 3% loan? No, they're not. And we're not even talking about the evolution of non-QM debt service coverage ratio that came out of the great financial crisis of 2008. Where you had more real estate than money. You have now more money than real estate. It's a complete opposite. There's never enough money for a great deal if the deal makes sense. I'm not saying to be ultra conservative. I'm not saying to be go into analysis paralysis, but the numbers from a cash flow perspective, the debt service coverage ratio work. If you're not looking at every property, whether you're going to flip, if you're thinking you're going to go on a flip, you better damn well think about it if you have to hold the property and the property does not sell, or you have a delay on construction, or a GC screws you on the third draw, or they disappear, or lumber goes up and there's a material cost shift in your estimates by 20 or 30%. Why don't you have a 20% contingency reserves in an account? God forbid you make a mistake on your draw schedule. I've seen way too many mistakes and not enough strategy discussion with the lender to better understand what you need to facilitate a solid buy, renovate, rent, refinance, and get into a solid debt service coverage ratio loan. There's a lack of education out there, and that's what we're doing here every Saturday and Sunday morning, providing that insight, following it up with events throughout the country, following up with webinars, following up with worksheets, following up with strategy discussions, and providing you a power team of referral sources throughout the country as well. I don't think non-QM lending is going away. I think it's going to take over probably 70% of the investment space, 80% of the investment space, completely take it away from the banks over the next 12 months, 24 months. I mean, there's just I just don't see the banks having an appetite for that anymore. Joe Martella, some feedback on. Oh, and I'm sorry, we've got to go to Timothy. I'm sorry, Timothy Doyle. Good morning and welcome. Brief overview: who you are, what you do, and your thoughts to DSCR in real estate investing.
Good morning, Joseph. Again, thank you. Good morning, room, and thank you for having me up and on. Always a pleasure to be up here with a lot of great moderators and great information. What do I do? In my FTE or full-time employment, I'm actually a project manager or an information systems project manager. But in the real estate investment space, I am actually a buy and hold real estate investor. I've been doing this for quite a few years up here in the greater Lehigh Valley in my own backyard. My thoughts to DSCR. It has its place, Joe. There are different investment engines for different types of investments. This being one of them, and one very good one to leverage, especially if you're looking to, as far as I know, and this is not my wheelhouse, Joseph, and this is why I'm glad I have you up here to help guide me and probably the majority of, I'm probably going to guess the majority of us, I don't want to really assume, how to leverage that and how that comes into play with your potential investments, or if you're looking to invest, or if you're looking for investment space. I still have questions. I'm still trying to always understand the product or how that is used. And again, it was very good
for those of you who have not gotten Mortgage News Daily, by the way, Joe, the 15 years at 6.31 and 30 years at 6.9, so good on. Actually down a little bit from October. Again, these tools are really good, really helpful, and even if you wanted to, or if anyone on this call wanted to, Garrett, James, and I had many of these tools that you could use in your toolbox on last week's discussion. So I'm not sure if that got erased, Joe, with what happened to the room this morning. I will say we do have an event this evening as well on this channel. Not to really change subject, but we were able to get an insurance broker, or someone who works for an insurance broker, to discuss your insurance needs for your investments currently, or if you're looking to invest. I know he does work mainly out in Pennsylvania, New Jersey, and I think he does Delaware. I will let Sean speak that. So we are looking forward to having Sean Wyatt from Rothenberger Insurance up online this evening. But again, getting back to my thoughts, Joseph, it's very good, very good. And honestly, I actually need to have a conversation with you regarding a repair for a property that was my main home that was supposed to be turning into a rental, but unfortunately, because the damages are so expensive, and the insurance company is, well, let's just say, being an insurance company, need to get that moving sooner rather than later. So hoping some point in time, maybe later this afternoon, I can bounce things off you. Unfortunately, that discussion would take up the rest of the time and then some of Clubhouse. So thank you very much, Joseph, for having me up on stage. Again, Timothy Doyle with Steel Hill Properties up here in the Greater Lehigh Valley. Remember, if you can't buy it, steal it.
Thanks, Timothy. Yeah, listen, I love having discussions to better understand how DSCR works. Are we bringing unicorns and leprechauns to the table? No, it's not the land of lending make believe. Okay, there has to be a real borrower. There has to be a real LLC. I really need to know who's in the LLC. I need to know who the borrower is. The individual calling on behalf of somebody else that's not on the phone, I immediately lose a trust factor in the whole transaction. So when somebody calls me and says, hey, I'm calling on behalf of my grandmother or my mother, why isn't your grandmother or mother on the call if they're the primary borrower or if they're in the LLC? Why am I talking to you? Why aren't we sharing the call? What are we trying to accomplish here? Is there something non-integrous? For whatever reason, a lot of people think you can get away with things in the debt service coverage ratio loan environment. There's still a level of regulation of understanding who the borrower is, what the LLC makeup is, what is the property going to be or what it is currently. And I could only use if the income, like Dave brought something great up, where I can't use future rents unless you're going to do a renovation to the property. And how are you going to get around a tenant knowing that, 70% of your states in the country are tenant friendly? I mean, let's just call it what it is, okay? When the landlord is the enemy. So how are you handling all these moving parts and being and understanding debt service coverage ratio? As a licensed real estate agent, as a licensed service provider, as a real estate investor, as a wholesaler, you need to understand these numbers and have honest, transparent conversations with somebody in your power team. If you keep going back to the well and giving bad information, they're not going to take your calls because they have to work with qualified borrowers. Nobody makes a living in the debt service coverage ratio environment not talking to qualified borrowers. Debt service coverage ratio loans are not for the people with a 600 score or below. It's not a life raft. It's for people that are qualified to maintain a property, that have kept credit above a certain threshold, and trust them and trust the income production of the property. It's not for the individuals that made mistakes and have a 580 credit score. I don't care how you got to a 580 credit score. It's not my personal business. but it does not apply and work for debt service coverage ratio loans. My answer to you is just fix your credit, and we can't help you doing that. Debt service coverage ratio loans is not a loan bailout either. Just because you've made all the mistakes, it's not my priority to fix them all for you. I'm sorry that you had a bad GC. I'm very sorry that you miscalculated your renovations. I'm sorry that that flip did not sell. And now you're over leveraged. There's nothing I can do about that. I had nothing to do with it. What I can do is give you the right answers to what is in front of us based on that individual asset, since DSCR is an asset-based loan. Joseph, your final thoughts. We'll go to David DeVito as well. But Joseph, your final thoughts to DSCR in real estate investing.
Joe, very educational for me included, but everybody on here. I think it gives a hedge against the competition for wholesalers and real estate investors alike. It definitely gives a hedge against people who don't understand what DSCR and how to maneuver within that realm and that world. And it's a value having you as someone who understands this world. I mean, as not only as a person who's been in the business for God knows how long. I almost want to say longer than I've been on this earth, but you're not that old yet.
Yeah.
So, but you know, you understand this like the back of your hand, and you can actually hold someone's hand and guide them through it. I mean, we threw the example of $50 a month, which that makes me cringe because there are expenses that come along. But as a new investor who may say, "Hey, I'm going to make $50 a month in the perfect world on this rental, even $100 a month," having someone like you underwrite it, because at the end of the day, you're not just a regular loan officer. You have an interest in the investor's success, because not only for repeat business, but it's also not good for you if you write bad loans. So having you alongside them underwriting that deal and saying, "Hey, $50 a month, number one, it's not really going to cover your expenses. God forbid you do have an issue, and $600 a year is not going to fix a water heater if it goes bad, and it'll eat up 2 years of your repairs." So, you know, you're definitely part of the power team, right? As much as I break your chops and I enjoy it dearly, but you're definitely one to reach out to.
Thank you, Joe. And listen, I might not have all the answers, but I'm going to take the time and go through and this is a call to action. I don't get enough phone calls from our listeners. Like, why aren't you allowing me to help you understand debt service coverage ratio? Why aren't we running 3 or 4 scenarios on the debt service coverage ratio worksheet together? Why aren't we working the cash flow worksheet together? Why aren't we working and penciling down the mail? Just don't throw the grenade over the fence with no pin in it. Let's go through it. I want you to really understand what asset-based lending does. Dave DeVito, any final thoughts? Dave DeVito, any final thoughts? Going once?
Yeah. Stay disciplined and never buy a deal based on. That's another big thing. I mean, it's all about discipline. You know, people are always so excited about a deal. It's tough in this market, but if the numbers don't work, don't try to rationalize it by kind of like bringing in extra variables that are just going to kind of like pacify your pie in the sky wishes. There's a reason why people get in trouble in real estate. That's usually the number one. So stay disciplined and be willing to walk away if it doesn't work.
Thank you, Dave. So next week, guys, I just want to let you know we will not be having a show 8 a.m. and 9:30 a.m. on Saturday and Sunday. I will be away. So Tim and Jim will be having their events midday. Timothy and Garrett will have their evening event as well. So I'm taking the weekend off with the wife. We're going away. So I there's always time to take care of yourself. I'm at the gym every morning, but I need to take a little breather, take a little vacation time with the better looking half. But I do have a quote this morning for you all to think about. This is how you let go. Feel your feelings without trying to avoid them. Cry, be angry, allow yourself to be sad. It's all part of the process. 2, reconfigure who you are, how the experience or relationship changed you. And number 3, forgive yourself. By acknowledging your humanness, you are not perfect. Making mistakes is part of the learning process. Don't beat up yourself for what you allowed. This is Joe Scarice, founder of the Creative Birth Strategies House, also the Creative Birth Strategies podcast, and influencer, and hopefully providing insight in Denver at the Great Mile High Summit and the Philly Realty 411 in March and April. Love to see all of you there. Love to see you back. Please download our podcast on creativebirthstrategiespodcast.com. We've had over 500 downloads of our podcast in the past 2 weeks. We're very excited about it. We have episode 5 already up there. We're going to have episode 6. And I'd love to extend interviews with all our listeners and engaged audience and moderators whenever we can have time, either on a Saturday and Sunday. Let's take a half hour. Let's dive into your business and really get it to the next level through the Creative Birth Strategies House. So everybody have a beautiful and blessed Sunday morning. I'll be ending the room in the next 30 seconds. Please follow Jim and Tim into the next room that they're holding. Thank you, guys. Take care. Thank you.